Welcome to the Daily Update, where I'll go over the action in the market for Thursday, May 11th, and then we'll see how things look for Friday, May 12th. We didn't see any follow-through action to the upside. In fact, we ended up having a down day. We've switched back more to mixed, especially in the short term. We're looking mixed in the intermediate term. We're still positive in the long term, but the upward action that we saw at the latter part of Wednesday's session didn't really carry through into Thursday's session. We're still hitting underneath some pretty significant resistance levels, and we have a lot of negative divergences, which we're still trying to deal with. Before I get started, please note from May 12th, which is today, until the 14th, I'm still traveling. I'll do what I can to post the next video. My hope is to have a daily video posted for Monday sometime before the market opens. I do have a new supplemental video that I posted a few days ago. Please feel free to check that out. I deal with the S&P 500 and its relation to interest rates. I do have a podcast, which is a carbon copy of what you're seeing right now. And in the podcast, as well as in this video, I have a PDF of all the slides and charts that you can download and follow along. I do have a private Facebook group that you're welcome to join, and then any other platforms that you might use, and I don't have a poll posted for this week. Let's go back and talk about what happened. Right at the open, we did have a gap lower open. We opened down below the daily pivot at 41.30. Then there was continued selling, but prices didn't get all the way down to S1 at 41.06. As the day went on, prices bounced between the daily low and the daily pivot level twice before closing at the daily pivot. So you could say that we closed up off of the lows for the session, but it really wasn't all that gangbuster nonetheless, and I'll show you the chart. We were down 0.17% on below average volume. That seems to be the norm again. The technicals are more mixed, as I said. Inflation and interest rates are really what the market is fixated on. We're hearing more about this debt ceiling situation, and I have some more information to tell you about that. And the banking stocks seem to be acting up a little bit again. We're having to wonder, is that going to come through with any significant news? So what are some comments that we can make? The PPI was taken as market friendly. The market really could have gone up after this report came out, but it didn't react to that. The debt ceiling concerns are still continuing. There's a fear of a hard landing that we're hearing more and more about. And the Bank of England ended up raising their rates 25 basis points to 4.5%. This was as expected. The NASDAQ and the NASDAQ 100 did advance, so we're seeing a little bit of an improvement there. The dollar was up and interest rates were down. The 10 to the 5 and the 30 to the 5 are back to being normal, where the other ones that we watched, the 10 to the 2-year and the 10 to the 3-month, those yield curves remain inverted. Sentiment is still positive. It's at 59 where it had been at 58. Our trend is still positive, but it's weakening because the green line is starting to come down even though it's on top. The ADX is also weakening because it continues to be below its moving average, and both of those are below 20. I've changed our bias back over to mixed and our momentum to mixed. We're back at kind of the same point we were at before. The economic reports that came out, PPI came in up 0.2%. They expected it to come in up 0.3%. Last month it was down 0.4%. The core PPI came in up 0.2%. They expected it to come in up 0.3%. Last time it was unchanged. The market could have used this to justify really going higher. Year over year, total PPI was up 2.3%. Last time, we were at an annual rate of 2.7%. When you take out food and energy, PPI was up 3.2%. Last time, it came in at 3.4%. So we're seeing a decline overall. Weekly jobless claims continue to go up. They were at 264,000. They had expected 247,000. Last week, we had 242,000. And I'm starting to keep an eye on the continuing claims. They continue to go up. They were at 1.813 million. Last week, they were at 1.801 million. Here's a look at the weekly jobless claims, and what we really follow here is the blue 4-week moving average to get an overall trend as to what's happening. And we can start to see that the weekly jobless claims are going up. Here are the continuing claims. The moving average is still going up, even though we're still a little bit below that. Then looking at PPI, we're showing over the 12-month rate of change how things are coming down. We did tick up just a little bit with the rate of change going back 1 month. Here's the core PPI showing how it is declining both with the 12-month rate of change chart and the 1-month rate of change chart. Then the debt ceiling. This came from a video that I have access to through stockcharts.com. You may have heard that Donald Trump gave a town hall meeting recently on CNN, and his answer was, hey, just let them default and then pick up the pieces from there. What's been happening with the debt ceiling and with his comments, we're seeing that credit default swaps, which are CDS, they are really starting to go up. They're at a higher level now than the last time we faced this debt crisis back in 2011. This probably will get worked out. It's one of these political things that Republicans and Democrats like to throw back and forth to try to get what they want out of the whole thing. And my understanding is the president is not even willing to negotiate any kind of cuts at all. At some point, this will come to a head and have to be dealt with. Getting into our analysis, here's a look at the intraday chart showing how we gapped lower below the daily pivot. We didn't come all the way down to S1 where we set up a base. We tried to come up to the daily pivot before, fell back down almost to the daily low, went back up to the daily pivot, fell down a little bit, and then closed right at the daily pivot. The 10-minute intraday chart of the SPY shows how we were a lot stronger overnight, but then we saw some weakness as the market started to open. It followed the same path as the market during the day, and right now we're currently up in the early part of the overnight session. Large cap growth continues to outperform large cap value, and I have another new chart here just showing the ratio between the two on an intraday basis. When this is going up, that means that growth is outperforming. When it's going down, that means value is outperforming. On the closing basis, growth was up for the large caps, where it was down for value. It was down, but a little bit less for the mid caps, but it was down a little bit more for the small caps. Looking at sentiment, our fear gauge ticked down just slightly, but still showing not a lot of fear in the market. The VIX continues to fall even with a down day. We were down a little bit on the line chart as well as the bar chart. The VIX of the VIX is still rather elevated here. We're seeing a bit of a pickup in volatility with this chart. And the equity put call ratio continues to fall. It has not generated another signal yet. The more this goes down, the more likely it is that the market is going up. Our other fear gauge is starting to turn down after it had been coming back up. And this fear gauge is starting to turn back up where it had been coming back down. We did get the latest reading from the American Association of Individual Investors. They're still pessimistic overall, but not giving an extreme reading. That's the black lines that you see on here. This red line is a 50-period moving average just to measure what has the trend been overall. And they're still tending to be more negative. We don't really follow this until we get to extreme readings below 30 and above 30. That's when we look to use this as a contrarian indicator. Folks are still favoring more of a risk-off posture. Looking at the advanced decline line, we decline based on price as well as volume. We're still seeing a short-term negative divergence where volume is below the moving average. Longer term, we're also working off of this negative divergence. The new highs, new lows are still continuing to drop on our 5-period moving average and slightly declining with the 10-period. We're just a little bit below zero now with our advanced decline line ratio, so that's more negative. Accumulation distribution actually turned up a bit, so this is one positive sign that we're seeing. Looking at the cumulative advanced decline line and the regular advanced decline line for the NYSE and then comparing it to the S&P 500, where we were coming up to previous highs, but we're seeing the negative divergence on this chart. Our broader range shows the NYSE is falling down below its moving average. The S&P turned down slightly. The mid caps are now down below the moving average, and the small caps continue to show weakness. Looking at common stock, we're still working off of this negative divergence where we made a higher low based on price, but a lower low based on volume. Our trend shows the ADX is still continuing to decline and it's below its moving average. That suggests that we are in a trendless environment. We do default to the positive because the green line's on top, but right now it is declining with the down day. Volume continues to drop off. On a short-term basis, nothing was really decided here. We're just about at this pivot point now as far as price is concerned for the S&P. And then on the bottom, you see where volume did drop to below average. We're just a little bit above the 20-period simple moving average. So you could lean a little bit more to the positive side. Our stochastics were above the 50 level and turning down in the short term. We're rolling over a bit in the intermediate short term, and we continued to decline in the long short term chart. The force index continues to be slightly above zero, even though it did decline. Intermediate term, the balance of power continues to fall, and it's below the dashed line. That is negative. We're just at the double exponential moving average now. Yesterday, we were at the triple exponential moving average. We've fallen a bit, and this could be acting as overhead resistance. The go-no-go system has switched back to more of a dark blue. That's a little bit more positive in how this calculates. The TTM squeeze is still tending to be more negative overall. The PPO study, we're still positive in the long and intermediate term, even though we're coming down. We're still positive in the short term, but we continue to fall, and we could drop below zero with any follow-through weakness. The Arun indicator continues to be negative. The McClellan oscillator, we're still showing this negative divergence between S&P 500 price and what the McClellan oscillator was actually doing. On a short-term basis, it's negative because it's below zero and declining. Our broader range NYSE McClellan oscillator is still showing a negative divergence and recent weakness. The Swindlen trading oscillator actually turned up a little bit, but it's still below zero. It's crossing above zero based on volume, so this could be a positive sign. The PMO continues to be negative overall, and it's also declining based on price and volume. Our PMO study still shows this negative divergence, and we're declining with those PMOs that are rising. The buy signals are flat to slightly down, as are the PMOs above zero. The Elder Impulse system continues to be positive for the S&P. The parabolic SAR continues to be negative. Our oscillators, as I've been saying, we're watching this top oscillator because it's the most sensitive. That's the slope oscillator, where all of the other oscillators continue to be negative. We're just barely above all of the plotted moving averages in our moving average tree. We're still seeing this negative divergence with the BPI, and on a shorter term basis, we have now dropped below 50, so that is negative. The NYSE bullish percent index continues to be below 50, went sideways, so this is negative as well. The Chaikin money flow has had a couple of good days recently. That could be a positive sign. The Chaikin oscillator is advancing and above zero. That is positive. The money flow index is still below 50. It was sideways, so it still continues to be negative. The ultimate oscillator is above 50 and advancing, so that is positive. The vortex, we have the red line and the green line pretty much on top of each other. On balance volume, we continue to be below a declining moving average. That is negative. The summation index is declining based on price and volume, and with volume, we are below zero. We're also working off of a negative divergence when we look at volume. The percent of stocks that are above their 200-day moving average continues to show a negative divergence, as well as the 50-period moving average. Looking at some line studies at the 4170 level, which we didn't get close to on Thursday, we still have this pretty significant overhead resistance. Looking at our short-term fib levels, if we do start to go up, we're looking at resistance at 4156. Longer term, if we continue to fall, we are looking at possible support at 4123. We're just barely above that right now, so it may not provide any significant support if we do fall. But if we fall even further, we are looking at some support at the 4020 level. Also, we're looking at potential resistance at this downward sloping trend line, where I measured from the two lows that were set in 2022 and then drew a parallel line going back to the all-time high. A lot of times we'll come right up to this level, hit that, and turn and go the other way. But so far, we have not come up to that level. Here's another new chart based on a video that I was watching before I started recording. There are two things to point out here. I'm going to be doing a lot more cycle research in the future, looking at 9-day cycles, 50-day cycles, 300, 2.5 day, whatever cycles, to see what I can come up with that is consistently workable and shows us some insight. Lately, over the last year or so, the 50-day cycle has worked out pretty well. If you go back to the all-time high, that's just about when we topped out. Then we hit a low 50 days later. Then we hit another low 50 days after that. Then we didn't quite get to the high when we were bouncing up in 2022, but we did hit a low back in October. And you can just see sometimes these line up quite well. Other times the line just comes and goes. We do have another chart looking out closer to the end of May where we might see another end of a 50-day cycle. This line on here is based on a Commitment of Traders report showing that there's a lot of not necessarily smart money that are heavily long in the S&P 500 E-mini contracts. If we start to fall, especially pretty significantly, they're very highly leveraged, and they're going to have to get out of those long positions pretty quick, and that could really put some downward force on the market. The video that I was watching put the 40-80 level at pretty significant support. If we break that level, we could see a real acceleration in selling. Again, we'll just play things out, watch other things that we keep an eye on, and then reach our own conclusions, but I thought that was pretty useful insight. Looking at our different charts, the Heikin Ashi is back to showing us a doji symbol now. The Keiki chart is negative with the red line, but it still is pointing up. Where the Renko now has redrawn and is looking more negative, the 3-line break is still positive. Looking at our different indexes, the equal weight index continues to underperform the S&P 500. Looking at our new take on Dow theory, where we are breaking out above this blue line with the S&P, we are above it with the NASDAQ. So we'll have to see, can this really get some legs and keep going higher? The transports continue to underperform the Dow. That could lead to longer-term weakness. The Dow is still above its 50-period moving average, even though it was down. We have fallen below these pivot levels currently, and the diamonds have switched to negative. The NASDAQ is looking like it could be breaking out above this previous resistance level now. Can it keep going? And the NASDAQ 100 also came right up to this R1 pivot level, and that could be acting as overhead resistance. The Elder Impulse system for the Qs remains positive, and we're still going up higher with our fib charts. If we keep going up, we're looking at the 13,614 level. We're still above this anchored moving average going back to the all-time high. The small caps, though, have given us a recent death cross and continue to show weakness. The Russell 2000, we're below 50 with the RSI. We're trying to get a little more positive with the MACD, but it's just not moving all that well. The Elder Impulse system for the small caps has switched to negative, and small caps continue to underperform large caps. The mid caps just giving us a recent death cross now and dropping below this pivot level. The mid caps have also switched to negative. The micro caps were down almost 1%, but not enough to generate a new 52-week low. The home builders rolled over just a little bit. The relationship between the home builders and the S&P 500 is still remaining fairly strong, but as the home builders have been going up and the S&P has been going down, we're seeing this relationship starting to weaken. Keeping an eye on the financial sector, we are still showing continued weakness. The financials continue to underperform the S&P, and the regional banking ETF continues to underperform the financial sector. Our interest rate studies, nothing has been decided yet. We're still in the middle of the rainbow, and this was the main focus of the supplemental video that I posted a few days ago. Looking at bonds, we're not really changing all that much. The relationship is getting a little bit better when we look at the correlation between the two, but they're still quite far apart from each other. Bond yields were down and bond prices were up. Our long-term look at the Special K shows that we're dropping a little bit further below the moving average. So we came right up to this red line and have turned and started to go back down. That could be negative. Looking at the MACD on the weekly chart, we're still going up, even though we're rolling over a bit with the MACD, which is suggesting this breakout above the trend line is legitimate, at least for now. An update of our possible positive scenarios, looking at the 19-day exponential moving average of the advanced decline ratio, we're well below zero now based on price and volume. Looking at our ratios, the Qs did outperform the S&P. Discretionary turned up slightly, and large cap growth is outperforming large cap value. Looking at our growth to value ratios, the large caps are showing some improvement, as are the mid caps, and even the small caps showed a bit of improvement. The S&P utilities ratio is still showing that the S&P is underperforming utilities. We're still below zero with our 5-period moving average of the highs minus the lows when we look at the Amex, NASDAQ, and NYSE. That is negative longer term. Longer term, our 50-period exponential moving average of the highs minus the lows, we did tick down, but we're still above zero overall. Our indicator is just barely starting to drop below zero now. The 2-year Treasury yield, even though it's falling, that has not given support to the S&P 500. And our staples, we're still wondering if this double spike here might give some support to stocks. So what's our outlook then for Friday? Earnings season is still continuing. The technicals are mixed. They had been looking a little bit more positive after yesterday. Now we've gone back to a mixed posture. The economic reports coming out, we have import and export prices, followed by the preliminary reading of consumer sentiment, and then the whole list of geopolitical events. Inflation and interest rates are really driving everything right now. We're still in the middle of earnings season. That could be positive or negative. Any Fed speak that we might get. But there's starting to be more of this debt ceiling news that's coming out right now, and then any other banking information that we may get. Looking at the Stock Traders Almanac statistics for May 12th, where we tend to be neutral to positive with the Dow being up 57.31% of the time. The S&P is up a little bit less than that at 47.36. That's neutral to negative. And the NASDAQ is neutral to positive, being up 52.4% of the time. And then we tend to be more positive than negative throughout the month of May. So our scenarios, really hard to go with the down one now because we are mixed and showing a lot of negative divergences. Hard to go with the up one now, kind of for the same reason. So we default to the sideways trend because we're weakening. The ADX is below its moving average. Both of them continue to be below 20. We are positive, though. The green line is on top, but it is declining. So our warning signs, there continues to be numerous negative divergences. The VIX is still showing a lot of complacency. The S&P is underperforming utilities. We're still in a risk-off posture. Small caps are underperforming, and we had a recent death cross with the mid caps. And then earnings season, which can be positive or negative. On the positive side, our seasonality and setups, those apply to the whole year, and they are positive overall. We do have lower price levels, which may provide support, especially that 4,100 level. It's acted as support for the last week to week and a half. The NASDAQ may be breaking above resistance. It had another up day. So our conclusion, the S&P is mixed. It's not trending, and it's showing a lot of negative divergences. We're mixed in the short and intermediate term, but we're still positive in the long term. So thank you. I hope you found this helpful. I hope to put out that daily video just as soon as possible. Have a great weekend, and I will talk to you in the next video.